Okay.
Okay. Hi, everyone. We're here with Michael. He is an expert on reverse mortgages. Oh, sorry about that, guys. Reverse mortgages. So,
Right.
we buy houses for cash,
Mm-hmm.
and sometimes issues come up where people need money, but maybe they can still live in their home, and there's other solutions. That's why we're bringing you out here to really explain reverse mortgages and talk about a few of the myths. So welcome, Michael.
Thank
Introduce
you.
yourself to us, please.
Hi. Good afternoon. Or actually, it's good morning, right? Good morning, everybody. Still on time when I was traveling last week, but yeah, good morning, everybody. Thanks for having me on the show. Yeah, I do focus and specialize on reverse mortgages and serving seniors through reverse mortgages.
And what's the name of your company and all that?
Actually, it's a Clear Mortgage.
Clear Mortgage. Okay.
Clear Mortgage. Yep. Clear Mortgage. And my website is michaelpancomortgages.com. So the entire website is dedicated to reverse mortgages. So no matter what page you land on, you'll never get lost there. It's always talking about reverse mortgage, but that's Michael Panco.
So let's start off with the first thing, which is what is a reverse mortgage?
Yeah. A reverse mortgage. Reverse mortgage is a loan that works in reverse. And what that means is, when you get a traditional mortgage, you make a mortgage payment, and over a period of 30 years, sometimes 15 years, sometimes 20 years, depending on the amortization, you pay off that mortgage balance and eventually you own your home. Well, with a reverse mortgage, it works exactly the opposite. Is when you get a reverse mortgage, you don't actually make a payment on the home, and you live in the home in perpetuity as long as you meet certain guidelines. You live in the home mortgage free. All you're responsible for paying is your taxes and your insurance.
Okay. So, and there's a lot of different ways to do this, but
right.
It is, you can get a lump sum. You can get, well, let's just talk about it. How does it work and who qualifies?
Right. So let's start with the basics. So reverse mortgage is for when you're working with FHA. So FHA and HUD have come together over the last couple of decades, and they're actually the ones that promote the program, manage the program, and actually execute on the program. So you have to be 62 and above. That's the first qualifier for an FHA HECM or home equity conversion mortgage. 62 and above. It has to be an owner-occupied home, meaning it can't be a second home. It can't be an investment property. It can't be your vacation home in Vail. It has to be a home that you actually plan to live in for at least 6 months out of the year. So it has to be owner-occupied. With a reverse mortgage, it's not a FICO-driven program, right? You don't have to have a job either, right? So how it works is we do run your credit. But that's not to determine what your FICO score is, which drives a lot of forward loans, a traditional loan program, right? But you qualify for the type of loan. Well, why we run your credit is to see what kind of debts you have, right? Because that factors into the qualifying, which I'll get into a second here. So we run your credit. And when we run your credit, we say, okay, what kind of car loans? Do they have a car loan? Do they have credit cards? What do they have that they have to pay for if they qualify for this reverse mortgage? Because they've got to pay for their taxes and insurance. We know that already. That's one debt. Then what debt are they bringing to the table with a car loan, credit card loans? And then they take the square footage of the property. For easy math, let's say it's 1,000 square feet. And they multiply it times 14 cents, which would be $140. So they take whatever debt you have, your taxes, your insurance, and they take that 14 cents per square foot or $140, and they say that's living expenses. They say, can the person, based on their Social Security check, their pension, their assets in the bank, whatever they have coming in, can they cover all of these expenses? And typically, there's not a lot of debt as it relates to credit cards and car payments. Typically, it's taxes, insurance, and the living expenses is what they're making sure that you can cover. In the past, and this is where some of the myths have come in, they weren't as tight. Let's go back maybe 15 years ago. They weren't as tight on qualifying the individual in terms of actually being able to make the taxes and insurance payment and also covering the living expenses. So people were getting the reverse mortgage, but then they weren't paying their taxes. And then what was happening 5 years later, the county steps in, whether you have a free and clear mortgage, meaning you don't have a mortgage, or you've got a forward mortgage, or you've got a reverse. If you don't pay your county taxes, the actual county can come in and take that property away from you. So that's where some of the bad reporting comes in. So they've done a great job of making sure that the senior actually can pay for the living expenses, the taxes, the insurance, and also any expenses they're bringing to the table at the time the reverse mortgage closes.
Great. So I understand that you can get a reverse mortgage. You can either get a lump sum, like to do some repairs or something.
Yep.
Or you can get a monthly income coming in.
That's right. Yeah,
right?
That's right. Yeah. So 90% of the reverse mortgages that are done at what's called a variable rate, meaning that rate can vary throughout the lifetime or the lifespan of that actual reverse mortgage. You do have a fixed rate option, but it doesn't give you as much access to your equity, right? Which is what a reverse mortgage is all about. If in fact, if you have enough equity and you don't have a loan balance that we had to pay off when we got the reverse mortgage to begin with. So with a variable rate home equity conversion mortgage or reverse mortgage, you've got lots of different options to tap into that equity. So for example, let's say that the person's 78 years old, their home is worth $500,000. They had a very small minimal balance on their mortgage, and they qualified for $200,000 in equity to grab from their property using the reverse mortgage. Well, from that $200,000, we pay off the $50,000 balance that they have in their forward loan, and that remaining $150,000 can be tapped into in a lot of different ways. And this is how we're going to answer your question. The first year, they could take roughly 60% of that. And then in year 2, they could take the remaining balance, no questions asked. So that's one way they can do it. They can wait after the 2-year or after the 1-year period, they can take all of it. They can take, referring back to what you talked about, which is kind of an annuity payment. There's 2 ways. It's called a tenure, TENURE payment, which is for the lifetime of the loan, right? For the lifetime they have the reverse mortgage, they're going to take that $150,000. They're going to take their age. They're going to divide that into 100, and it's going to give them a monthly payment. So I did one up in Shingle Springs. Guy was 69 years of age. He got $250,000 in his line of credit, and his monthly payment on that until he was 100 was $848 a month. Okay.
And now he can do whatever he wants with that money, right?
He can do whatever he wants with that money. There's no restrictions. The last way that you can take it out, and this is where I love reverse mortgages because there's so many detailed conversations you can have with financial planners. You can use it as a strategy to delay things like Social Security. So let's say you're 62, you want to retire, you do what's called a term payment, and between 62 and 67, which is your full retirement age, and if you want to really extend that and take it out to 70, you say, you know what, I need on average $2,000 a month to fill the gap between my pension and what I've got in reserves. Well, you can do that with, as long as you've got the equity, you can do that with a reverse mortgage for a specific amount of time, take a specific amount out of your line of credit, and you can fill that gap and delay accessing your Social Security. So it's a great tool for financial planners with assets under management, buffer strategies. It really serves as an insurance policy to hedge against the sequence of returns in the bad years.
Okay. Well, let's go into some of these myths. Okay.
Okay.
So some people, one of the myths is with a reverse mortgage, you are selling your house to the bank.
Right. Which is not true. That's not true at all. So you retain title to the property just like you would in a forward mortgage. It is your home, right? It is your home. And this myth number 2 here, where I see when the loan balance is larger than the value of the home, the borrower pays the difference. That is not true. Remember, I talked about FHA being involved. One of the myths that's not up here is that, are the questions we get, is a reverse mortgage expensive? Depends on how you look at it, right? It's the only product in the market that allows a homeowner to dip into their equity and not make a mortgage payment in perpetuity. So that's number 1. But remember, a reverse mortgage is a non-recourse loan. As long as you meet the guidelines, they can't take the house from you, period. End of discussion. They can't do it. So FHA puts a 2% insurance premium when you close the deal, which typically comes out of the equity. So that's the biggest expense as it relates to getting a reverse mortgage, which is paying that upfront mortgage insurance premium, which goes into the coffers with FHA. But again, you actually own the home, you retain title, the bank does not.
Okay. Another myth I always hear is that when I die, the bank gets the house, my kids don't. Yes.
This is probably the biggest concern when now we're talking about legacy, right? This is usually the biggest concern that the kids have regarding reverse mortgage. And this is where HUD and FHA really, again, this is why when people say, gosh, a reverse mortgage is expensive. No, they put in so many safeguards. And here's how this works. If something happens to the person that owns the home and they have children, 4 things can happen. Number one, if there's not enough equity in the property, the kids don't want to deal with it, right? Let's say mom or dad have had the reverse mortgage for a long time, and the house is worth $500,000, but the reverse mortgage balance is $525,000. Well, there's nothing in it. They can just walk away, deed in lieu of, and there's no big deal. Now, if they want to sell the house, okay, they want to work with somebody like you and sell the house to you, and there's $300,000 in equity, well, then they've got a year to get that done. They've got to call the servicer and say, hey, we do want to sell the property, right? We've got the title, we've got this, we've got that, we've got the right to sell the property because we're the kids and it's in probate and blah, blah, blah. Well, then the servicer will say, okay, let's get it listed, let's get it active, let's get it marketed, and let's see if we can get it sold in the first 6 months. If they can't get it sold in the first 6 months, as long as there's activity, they can get 2 90-day extensions to get that done. And then the kids take the equity just like they would if there was a forward mortgage on the property once the reverse mortgage is paid off. But here's where the huge benefit is, and this is what I love to tell people because most people don't know this, is that when you make a forward mortgage payment, you get a 1098 at the end of the year for the interest that you paid, right? Depending on your tax bracket, depending on what's going on, that becomes a part of a write-off. That's one of the benefits of owning a home. With a reverse mortgage, remember I said we don't make a payment on a reverse mortgage. So there's deferred interest that keeps stacking up. That's how the bank makes their money, right? But guess what? When you sell that home, that's when that deferred interest is paid. So if something happens to mom and dad, the kids inherit the house, they sell the house. Not only do they get the equity, but they also get the write-off from that deferred interest that's now paid when the house is sold. It's a huge benefit. Okay? Huge. And there's a couple other ways they can do it too. So if they're on title and they want to refinance for the amount of the reverse mortgage, and as long as they qualify, then they can do that. If they want to buy the house, there's other protections that are put in place. For example, if the house is valued at $500,000, FHA says if the kids want to buy the house, then they pay 95% of whatever the appraised value is. Has nothing to do with the balance on the reverse mortgage. That's why it's doubly insured by FHA. So if the loan balance was $600,000, house is worth $400,000, they're going to pay 95% of the $400,000 to buy that house.
Right. So the bank eats the rest, right?
And the bank doesn't eat the rest because the mortgage insurance premium covers it.
Yeah, because they have an insurance policy in there.
That's right.
So look, I got to tell you, I run into people all the time.
Yep.
And reverse mortgages can be an answer for families. And again, everybody needs to sit down and talk to someone like you to see if this is a good solution. If they really want to keep mom and dad in the house. One of the things people need to know though is if mom or dad, whoever it is no longer living in the house.
Yes.
Like they move into assisted living, this has got to be dealt with. The loan. That's
correct.
Right. Because that stops all the action, stops all the payments, all that stuff. But again, when we're talking about that interest write-off that can happen all in 1 year, that can help mom and dad qualify or defer some of the income from selling the house out so that they can still qualify for different programs. So again, this is not something that is always easy to figure out on your own. And you need to get, people. It's one of the reasons why I brought Michael on. He's one of the resources we provide when we're talking to people about whether or not maybe they don't need to sell their house. Maybe they can do a reverse mortgage and get what they need and get the house fixed up so they can stay.
Yeah.
And then later on, when it's time, when there's been a reverse mortgage, he can also help us to deal with the reverse mortgage with the family. So
that's right.
Again, Michael, just tell us all how we can reach you, your website and everything.
That's my cell phone number, the 916-296-7765, or you can visit me on my website, the MikePankoMortgages.com, and you can email me there as well. It'll come right over to me. But don't want to forget this. I don't know if we're done yet, but Laurel, you can also do what's called a reverse mortgage purchase. And that's also something where seniors, if they want to downsize, sell their home, and then buy another home using the equity, they can do a reverse mortgage purchase and not have a mortgage payment for the rest of their life.
Yeah, that's right. That's absolutely right. So, hey, you can give us a call at Laurel Buys Houses or call Michael at his cell phone there, and we'll leave it open. And you can always call my office. We'll give it to you as well. Thanks a lot, Michael, for being with us. Thank you, everyone, for joining us on these Facebook Lives. We hope that both our clients as well as some of the professionals we work with find these useful. And you can always suggest a good topic to us. We're always looking for great people to come on and share their knowledge with us. Again, thank you, Michael. Thank you, everyone.
Thank you, everybody. Have a great weekend.